Also surging in the pre-open. Let's see if it can follow through in the actual market opening. Okay, so we are off with a 55-point up move, so not bad at all. That's how the Nifty's opened up. The mid-cap index is also up about 0.3%. Tata Motors right away. Tata Motors is up to 2.5%. Pull up the DVR. That's the one that has been really surging, 15 to 16% up on Tata Motors DVR. And Tata Motors itself reacting to what were an excellent set of numbers that came in yesterday. L&T, the market's looking at obviously the very smart revenue and order book growth the company has put forth, so about 3% up on that stock. Bajaj Auto, Infosys, Power Grid. A lot of stocks on the upside of the screen as we start things off. SBI chipping in with a small gain as well. Asian Paints is still suffering losses despite yesterday's 4% fall, still down about 4%. ICICI Bank is a little subdued, and some of the steel stocks after yesterday's stupendous rally, some of the steel and even non-steel names like Hindalco, they are off to a quieter start. But otherwise, looking good. 50 points higher on the Nifty for now.
Well, that's right, should be. But, the stock that's in focus is Canfin Homes. It was down closer on 4% yesterday. We had the management that's saying, told us that fraud that's committed, it's a branch-specific issue. But for the time being, the street doesn't like it. Maybe the quantum is small. But it's happened yet again. So that's why that stock's down closer on 5.5%. Jubilant Foodworks as well. Yesterday it ended higher. Today it's pulled back closer on 2.5% of those gains. On the flip side, you have KPIT Technologies will be joined by the management in the next 20 minutes or so. That stock's opened up with a gain of closer around 2%. Dixon was more or less flattish, I think, to kickstart a trade. And Amber was the other one that would be reacting to numbers. Dixon, the stock has had a good run from last quarter to this one. So that's why that's more or less flattish. But Amber as well, they've uploaded further details with regard to their presentation. And Amber Enterprises is down close to around 2.5%. I think some part of the street expected numbers a little bit higher than what they delivered. Prashant.
Okay, well, lots of stuff opening up, and this is interesting as always. So let's just take a quick look at a few other names. L&T is up 3%. It's coming up with large volumes. I mean, actually, there's Tata Motors, the shares, DVR, and then L&T in that order in terms of volumes traded. Adani Green is up about 3.33%. Piramal Enterprises, that buyback announcement, the board will consider a buyback 3% higher on that one, 1,034. Stock's been an underperformer. Jyoti Laboratories was up 20% yesterday. It was the big mover, earnings mover of yesterday. It's up another 4% and moving up 303 on Jyoti Laboratories. CEAT moved sharply higher. We've got the management joining us. It was a big gainer yesterday. It's up 3% this morning. UTI AMC, I think we mentioned that, 4.25% in the green. Stocks at about, 845. JK Tyre is another one. So tire names, and we've seen this once or twice in the past as well. They move as a pack. I think it was the last quarter numbers. It was MRF. The numbers were super solid. EBITDA growth of some 30%, I remember. And then that triggered a rally in tire stocks for the next couple of days. We've got Gensol Engineering, which is up about 3.5%. And then some smaller names, so volumes not very much really there. Canfin is down a full 6.25%, 796. The markets don't like it. Adani Transmission is down 1.5%. We've got Suzlon, which is down 5%. I think Suzlon was locked in lower circuit yesterday as well. It's down another 5%. Earnings came out. We've got what else? Jubilant Food, which is down about 2.34%. Again, earnings there, mixed kind of view on Jubilant Food Works. And SRF, numbers were disappointing. Guidance was poor. And there was a conference call yesterday. Again, not very much by way of clarity. The stock, in a way, was perplexing because it sold off and then pulled back very sharply. It actually ended higher. And today, it's starting a 1.5% lower. So keep an eye out on that one as well. ACC, NHPC, Scient are some of the other names which are slightly lower in trade. We got a 40-point move on the Nifty. We're at 19,718. Mihir Vora is now joining us. He's Director and CIO at Max Life Insurance. Mihir, great to have you with us here. Thank you very much for your time. I think we are far into the earnings season for me to be able to ask the question, what has been the assessment so far? Hits, misses, what's the ratio?
See, the biggest sector, which is financials, has broadly been a positive. There have been more positive surprises than negatives, I would say. The second biggest sector, which is IT, there have been some disappointments. we are seeing decent set of numbers in the discretionary space, in the industrials and infrastructure space. So I would say overall, mildly positive on a net basis.
Positive on a net basis. Okay, so Mihir, let's talk about some of the more positive aspects. I mean, look at, for instance, how the market's reading through the L&T numbers. I remember last quarter there was so much disappointment about the margins, but now it seems the market has decided to follow the management's guidance, and by the end of this year, I mean, they'll be off to a better margin trajectory. How would you read through some of the industrial numbers? I mean, L&T is actually the first of the big ones. We're still awaiting a lot of the others. But given the run-up in stock prices in the capex side of the market, do you expect the corresponding earnings delivery to come through?
I would think so, yes, because the themes that are driving individual stocks are quite varied. It's not one big, one big theme like real estate or private sector setting up used steel plants or cement plants. This time around, it's, I think, a whole host of investments being done by mid and small cap or mid and small enterprises across the board. And plus, we have 2 or 3 big thrusts from the government side, which is also helping a lot of these mid-sized capital investments. For example, if we talk about defense, if we talk about railway spending, if we talk about we talk about investments in transmission and distribution. Road anyway has seen momentum for the past many years. But these 3 or 4 new themes like distribution, defense, railway capex are things which were not really present earlier. And the kind of order rollouts that are happening across these segments, and most of them are institutional and government-linked entities, gives a lot of visibility for the next 3 to 5 years for some of these stocks in these segments. So capex and investment cycle, on the government side, plus real estate also seems to be picking up. So I think we can see a continuing round of earnings upgrades in this segment for a while.
Sure. On L&T, I just want to remind our viewers once again that it's not just the fact that the top line growth has been great. Let's not forget there's a buyback. It's a 10,000 crore rupee buyback and the price is 3,000. So it's a handsome price that they're offering. And there is a special dividend of 6 rupees. I think lots of other triggers which are probably very supportive for the stock today.
Indeed. Mihir, good morning. How do you approach the markets though? I mean, are you in the camp that believes maybe the headline index goes in for a phase of consolidation, but mid-caps will do well? Or do you think the mid-caps just in the near term, they've run a little bit ahead of themselves?
Yes, I would be more comfortable with the large cap indices than the mid cap and small cap indices, because while we did talk about all these themes and exciting growth areas, stocks also have moved quite a lot. In fact, the fact is that so much money is coming into mutual funds, I guess, and the PMS EIFs. Most of them are focused on the mid and small cap space. So to that extent, I think retail and HNI investors are chasing performance, which is not necessarily a good idea at all points in time. So if I look at the overall valuations and growth equation, I would say the large cap indices like the Nifty or Sensex give me more comfort.
Are you getting a little worried about the action in the small cap space, Mihir? Or you think that's not an issue? We had Jakes with us earlier, and Jaikumar with us earlier was kind of saying, well, as a strategy, maybe, be more weighted on large caps now rather than small caps.
Exactly. That's what I said. If I look at the growth valuation equation, yeah, the Nifty and Sensex, which are the large cap indices, give me more comfort than the next 150 or next 250 stocks. I mean, not that there are no stock picking opportunities, but one needs to be more selective than one was, say, 3 or 6 months ago.
Okay, got that. By the way, there's an interesting play on tire stocks today. SIAT's strong performance seems to be having a bit of a rub-off effect on the others as well. Whether it's MRF or JK Tire, a couple of the other tire stocks are also up and about. And so is Jyoti Laboratories. I want to point that out. Remember that 20% dramatic move yesterday? You're getting another 3% on top of that this morning. Mihir, what's the sense on FMCG, consumer and FMCG? Asian Paints was very, very interesting. The numbers are fantastic, but I think the market's already looking ahead to other concerns in the sector. Maybe it's competition. We had Jubilant's numbers come through. What have you made of consumer earnings and how are you positioned on the sector?
Well, the original theme that has been developing is that the worst of rural slowdown should be over, and the worst of commodity price pressures also should be over. There is some kind of hiccup to this thesis because of the flood situation in some parts of the country. But we are still keeping our fingers crossed that rural demand should come back after the monsoon is over. So that is our base case. Commodity prices also seem to be moving up again because of certain issues, like, for example, the rice ban that India has or proposing has had some impact on global prices. Wheat prices are going up because of supply bottlenecks emerging in Ukraine. So while for the last 3 or 4 months we have been kind of betting on the commodity price pressures reducing, and we've been adding a bit of stock, but these couple of developments on the raw material side are giving us a bit of a question mark, I would say. But we'll take it as it comes. Overall, if you see, I won't be too overweight on FMCG because if we are betting that India is going to go back to 6.5 to 7.5% growth trajectory, then I think the cyclicals, like we talked about, financials, the industrials, and the consumer discretionary space, they actually might be more exciting spaces to be in rather than FMCG. Like sectors like FMCG and IT tend to do well when there's volatility, when there's question mark on the other segments. But if we are going back on a growth path, then probably the cyclicals will be more exciting.
Mihir, one sector that re-rated in the last 2 to 3 years was the chemical space. It did very, very well. But now there are clearly cautious signs that are coming in there. How are you all positioned out there? Did you all have some exposure? Have you all trimmed that down? Or do you believe that in the longer term, still the chemical space here in India will do quite well?
Yes, we believe that volume growth in the chemical segment is a given for the next many years. A couple of things. Some of our companies have developed very niche skills in some of their segments. So we have to look at it stock by stock. But more importantly, the diversification away from China is impacting the chemical space the most. So I think the level of confidence that I see in the Indian companies and the kind of volume expansion that they are doing does look like some of these companies will scale to global, if they are not already, will scale to global sizes, and they'll be economically and competitive, financially competitive versus China, even without subsidies or any kind of scheme. So I think volume growth is not a problem. Price growth, of course, we have seen some correction because China did come back after the lockdown, etc. So production has come back. Plus, Chinese local demand seems to be, flagging off. So there might be some element of pressure from Chinese supply. But I think structurally, if I were to take a 3-year or 5-year view, the top 4 or 5 companies in the chemical space are going to become a global class and global scale, I would say. And this will do well irrespective of commodity prices.
All right, Mir, we'll leave it there. Thank you very much for joining us, and pleasure speaking with you, as always, here on CNBC-TV18. Just want to take a quick look at what's happening in some specific stocks. Look at something like a Tata Motors Jewelers, which reported numbers, I think, day before yesterday. We spoke with the management yesterday, and very strong numbers for the second quarter in a row. Yesterday was a big day for Tata Motors. The day high was about 1164. It cooled off, closed at about 1,040 off the day's high, but it's up another 6% today. So making up some of that lost ground, although yesterday was a positive day, and today is as well. So very, very strong week. 30% this week so far from last Friday's close. So some of these moves are just incredible. Look at something like a Marksans Pharma. 5% move on Marksans Pharma right now. Out of the blue, there's something, I think this is Ajmera Realty. It's got an 8% move coming through.
That's on very, very strong results. Ajmera's results came out, and at least on the face of it, they look really robust.
Right.
So maybe that's, powered up the stock.
Spandana is another one, right? 3% higher. Again, there were numbers to boot. So, yeah, this is picking up. Electra Green Tech has been falling, by the way. The high was about, almost $1,500, Electra Green Tech, which was not that far back. 13th of this month, earlier this month. And then, it made a low yesterday of about 1,073, and it's trying to come back up about 1,142 or so. Over the years, it's been a big outperformer. So, yeah, there is no dearth of activity or action. The market, the Nifty itself is up 74 points, and it is interesting. So, keep open to the idea, as I was saying in the morning, that as I was saying, sometimes the markets go sideways We did see for 4 or 5 days slightly sideways action, hit an important level. That level, as I pointed out, was 19,620 yesterday. The low was 19,617. And, then that gets completed. And then the market starts to make a fresh impulse move higher. So maybe, but it'll get confirmed only by later today if these gains hold. But be open to the idea, notwithstanding the fact that the market's done so well, it doesn't have to correct necessarily. So I'm just saying that be open to both sides of what the market can do. 19,750, 19,751 is where the Nifty is at. Surabhi.
Prashant, I just wanted to point out exactly the thesis that you were sort of alluding to, that today, after many days, we're seeing stocks beyond earnings as well take off. And these are big names. Look at Reliance today. Look at Infosys. Look at NITC, which has finally stopped falling. So a couple of these big boys are kind of coming in and they're supporting the market. So it seems to have more legs. Though, of course, L&T and Tata Motors are the news drivers. But a couple of others have managed to come up on the top side of the screen.
I think on the upper end, what I'm looking at today is 19,780. I made this point earlier as well because we had a lot of open interest, more than a crore shares at the 19,700 odd mark, the 19,700 call. The premium out there was around 80 rupees yesterday on an average. So for those call writers, they are expecting the 19,780 odd mark to hold out. So that's the resistance mark. If we can somehow get, another 30 points, 25 to 30 points higher, and then in fact hold above those levels, that's what could give an additional fillip to the bulls. And in fact, we could move up as well. But let's get straight to our next management that we have on the show, Bajaj Auto. Well, it was a pretty strong performance coming in the first quarter. The company reported the highest quarterly EBITDA in quarter one. Revenue has surged close on 28%, while margins as well expanded. Mr. Rakesh Sharma, the ED Bajaj Auto, joins us to discuss the numbers. Hi, Mr. Sharma. Good morning. Thanks so much for joining in. Well, first things first, on the margin front, that's been improving, and that's looking quite good as well. For the third consecutive quarter, we're holding about that 19% odd mark. Do you think with operating leverage and lower input cost, things can get even better from here? And just one more point, the other expenditure I was looking at, on a sequential basis, it's down by close to around 7%. Was there any one-off or no?
Good morning. Yes, we are very pleased that we managed to hold the margins at 19%. The Bajaj Auto margin is a blended margin of very distinct business units. And ultimately, we don't end up actively managing the overall margin. We obviously manage the various inputs and the business units to maximize the performance both on top line and bottom line over there. And then depending on the mix of these business units, which are pretty disparate, international three-wheelers, domestic motorcycles, and now, of course, the electric. And the blended margin, therefore, has little direct control. Having said that, looking forward, we don't see much pressure as at this point of time on the input cost. There was some movement in the early part of the quarter one. And of course, there was the OBD2A related costs, which we have recovered through price increases. So we don't see an issue over there. We see exchange rate stability. So we don't see an upside over there. So our story of ever improving mix in our motorcycles business and the increase in the three-wheeler business are both sort of positives for the margin story. I don't think we will get much joy on the operating leverage because Q2, our aim is to, match the Q1 performance. That'd be very good outcome because, as you know, Q2 is, particularly when Diwali is delayed, Q2 is a very subdued quarter due to monsoons. But we are hoping that we will be able to accelerate in the premium segments. There should
Mr. Sharma, Mr. Sharma, the street will want to know, what could be the broadband then? Give and take everything, premiumization, no operating leverage. So, yeah, please go ahead.
Yeah, so I was just about to conclude by saying that when you put all these elements together, we hope to bring in the margins at similar levels.
Q1 levels. Mr. Sharma, hi, good morning. Prashant here. On exports, things continue to improve on a quarter-on-quarter basis, month-on-month as well, as we've been chatting when the monthly numbers come out. Could you draw a picture for us briefly where things stand as of now? I mean, as at the end of the quarter and as of now, how much better are things, and directionally, where do you see them?
Sure. I would look at the retail movement on the ground in our market. So at a global level, the retail movement of the motorcycle industry has been 2%, which is indicative of a bottoming out. As you know, that quarter on quarter, entire last year was a decline. And for the first time, quarter one, industry retails are 2% up over quarter four. And our retails are on the ground 5% up over quarter four. And then when I take a further cut, a deeper cut on this, and I look at the top 15 markets which we have, which account for almost 80% of our sales, there the retail industry has grown by about 5%, and we have grown at about 7% sequentially. So this is very good news. However, when you sort of dive in a little bit more, in the underlying, there are still some hotspots. There is still some uncertainties. The entire improvement has been driven by Africa, which is the retail at a retail level. It has increased by 14%, and Latin America has held steady. But South Asia and Middle East, thanks to underperformance in Bangladesh and Nepal, has not yet returned. And we have experienced, I would call it a temporary dislocation, but a large one in ASEAN and Philippines, where the government has changed some registration norms, and there is a new process, which is now almost towards the end of adoption. So we hope that that will sort itself out by September latest, and it will come back to growth. So therefore, because of these uncertainties in a few key countries, we are still saying that let's watch one more quarter. We are optimistic, but the changes are going to be incremental. They're not going to be quantum shift. So yes, quarter two will be probably marginally better than quarter one.
Just to understand that, Mr. Sharma, you said that things could normalize by September on exports. So are you saying that perhaps you will start looking at year-on-year growth? And is that on a monthly run rate basis? Or are you saying maybe third quarter onwards, the export numbers could show some growth on a year-on-year basis as well?
Yes, you see, the last year, it was, the slide had started in the markets from May, June. So definitely from that point of view, quarter two and certainly quarter three will start to show growth over the previous year.
Okay. Let's talk about the premiumization drive and, the headlines that we got in June and July around Triumph, of course. What's the run rate that you've set out for yourself over there? And with that, also just tell us overall, on domestic volumes, what is the expectation for the year as a whole, and also specifically from the top end of the segment?
So we have been consistently following the approach of driving our share and driving category growth in the top half of the motorcycle industry, which has also got some tailwinds. This is the 125cc plus segment. And just to give you an idea, this segment contributed 60% of our domestic sales. And in quarter one, it has contributed 70%. So it's quite a shift. And this obviously has some positive implications for both revenue and EBITDA. And this shift has been driven by sub-segmenting this segment and offering very pointed product propositions over there under our flagship brand of Pulsar. So we are going to continue this. In the next 3-4 months, you will see a few more introductions, new variants in the Pulsar stable, which will be targeted at different sub-segments. And we hope that this drive of premiumization, not just for Bajaj Auto, but in expanding this overall this segment will continue. And of course, the entry of Triumph is very, very helpful. But I think it will still take about 6 months to 1 year for it to fully blossom and make a significant impact on the numbers. It's a good beginning, and we are taking it step by step.
Oh, absolutely. It'll be very interesting to see the pickup, and it's a very interesting market, and there are some great products. There's a lot of competition. So I think the next couple of months will be very, very interesting from a customer perspective for sure. We have a customer sitting right here next to me. So yeah, I think the top end of the bike market is really hotting up.
Well, indeed. Well, let's get to our next management then.
Yeah, I think we'll have the management of KPIT Tech joining in the next couple of minutes. I just want to run our viewers through some of the revenue numbers, because in terms of top-line growth, KPIT has probably been one of the better performing companies with a revenue run rate of 7.1%. That's quarter-on-quarter growth. And the company has also managed to maintain its guidance as well. So let's try and get some more color on the business. Kishore Patil, co-founder, MD and CEO of KPIT Tech, is with us. Thank you very much, Mr. Patil, for joining in. So you tell us, I mean, the market would, of course, take any positive outlook or positive numbers from the technology space with both its hands. So tell us, what are your clients telling you, and how is it that you've managed the 7% growth, and what gives you the confidence on retaining the guidance as well for this year?
So good morning to you. I guess we have been very clear when we gave our outlook for the next year also, that there are fundamentally three things which we are talking about. One, we are saying that the industry trends on which we are banking upon, they are still growing, whether it is electrification, autonomous, central architecture, all this enabled by software. This continue to grow, and OEMs are investing into this. That's the point number one. Point number two, we said that we are absolutely very well positioned, as we are in the pole position to really take the benefit of it, or maybe engage with the clients on these areas, being a strategic partner to 25 clients. That is the second part we are saying. Third part is our clients basically are continue to spend, and they are quite well engaged, and this is a priority spend for them. Last but not the least, I think if you look at our wins of deals which we give new deals wins, etc. I think that has been strong, and it has been consistent across the quarter. So with that, what we have said is with that visibility and on the ball, also the back of couple of large engagements, we mentioned that we have a clarity. H1 will be stronger than H2, because anyway quarter 3 is a bit anyway softer. But overall, we have been confident on that, and the way we have started on a strong note with the quarter 1, I think we feel very comfortable saying that we will meet our outlook for the year.
Mr. Patil, good morning. Prashant here. If anything, the question many are asking is, why have you stuck to that 27 to 30% growth guidance? Why is it not higher? I'm sure you've been asked that. And is there room for that to go up? Will you upgrade it? Is there a chance?
It's about the point, right? First, we are giving the guidance. Many companies are not giving the outlook. We are giving the outlook. We are giving a stronger outlook. And our policy is not to give a quarterly guidance. We give a guidance at the beginning of the year. We take our best shot to give that. We are not very conservative. And then we revisit the guidance at the end of the quarter 3. That is, as a policy, KPIT has been doing for multiple years, unless we do any significant acquisition in between. So based on that, that's what we are doing. I think there's nothing much to read.
So upgrade to guidance in third quarter. Sorry, I'm putting words in your mouth. But anyway, let's hope.
I'm not saying it. But at that point of time, we'll take a look and we will share with you whatever it is.
All right. Hi, Mr. Yeah. All right, Mr. Patil, let's move on then. I wanted some clarity on this. Honda recently announced a partnership with SCSK. Now, the fear is that Honda is diversifying its vendor base. Your comment on it, is the scope of Honda and SCSK different from Honda KPIT?
I really think the market is in a really not a great mood. So people are looking for
No,
a
market
negative.
is in a great. No, actually, Mr. Patil, market is in a great move, but they want to know whether or not there is a risk to KPIT's business. So please comment on this.
Yeah, of course I will comment. Because there is nothing to comment. Actually, what I have said, if you look at it, this is KPIT continue to engage. We are actually ahead of engagement with the Honda. We are we have said that we are actually accelerating our ramp up for this engagement. Not only that, we are seeing many opportunities beyond what we have got. So that is not absolutely has no relevance, no impact on the KPIT part.
No, but I think, Mr. Patil, what the market is trying to understand, at least one section of the market believe that your tie-up with Honda is exclusive in nature for at least the businesses that you are executing with them. But now it seems that this Japanese IT company, that this is also executing a business in the same area. So then, therefore, there's no exclusivity with Honda as such, right?
So the first thing is, let me tell you that absolutely we are working as a key partner to Honda. We never claimed that it was exclusivity, but we are. That also I'm telling you. But I will tell you how it is. The way it is if you look at any project, there are things which the Honda by themselves they have to work on. Then there are projects which are into the overall platform play, which we talked about. That is something they have to do on. And then there are a few other activities around. Now that platform activity is what KPIT is working on. And that absolutely KPIT is the one who is working on that. And as I said, we have ramped up. We are ahead in the schedule. We will continue to deliver on that. And there is no change in that. And not only that, what we are seeing is we are seeing more opportunities in that. Now,
I was just coming to that, Mr. Patil. I was just coming to that. So, okay, you've clarified that there's absolutely no impact on the deal that you've done. But I think the market also is looking forward to the future. The market's hungry for more, right? They're wondering whether you can do more such tie-ups with Honda or maybe Renault or any of these other large global auto OEMs. Is there more in the pipeline?
So that's our business model. I think we are, you look at the growth numbers, you look at the scale, I think, and you know what is happening otherwise. So naturally, our strategy is working. All our 25 clients are spending. Our relationships is strong. And we are seeing that growth everywhere. Not necessarily there will be, I have mentioned it many times. That doesn't mean that there has to be one big announcement. I mean, for example, I'm just saying, as everybody knows, like with Cummins, we have been working for many years or this, or you also know in some areas with other European companies. But that doesn't mean you have to come up with one large announcement. It's sometimes it happens, but the point is the acceleration, growth, engagement is growing across the clients.
Got that, Mr. Patil. Great numbers, blockbuster really for the quarter, and we hope to speak with you soon again. Thank you very much for joining us with your assessment of things as they stand right now. Well, we're on a clock and we're going to take a quick commercial break here. 90 points, so this is looking good on the Nifty. We're at the day's highest point, 19,772. Dixon is the next management that you will hear from on the back of their earnings on the other side. Take that break. See you on the other side. Okay, well, 88 points. Things are looking super strong, and it's green out there. Market breadth is also positive, 2:1 in terms of advances to declines. As promised, we've got the management of Dixon Technologies now joining us. The stock has done very well. I mean, the bounce in these companies, Dixon and some of the others like Camber, Keynes, etc., Sirma, etc., has been very, very strong. It's up another 1% this morning. We've got Mr. Atul Lal, Managing Director of the company, joining us. Mr. Lal, great to have you with us here. So, revenues have been in line with what the market was expecting, but maybe on the margins, perhaps there is a little bit more to be desired. So let me dig right into specifics. So on the consumer electronics side, margins have come off a little bit, 3.4% compared to 3.7% quarter on quarter. And on the lighting product side as well, there is about 100 basis point contraction in margins. What happened and what's the outlook in these two areas?
So Prashant, in our industry, there is an element of seasonality. So I think I'll request that it be more prudent to compare year on year. If you compare year on year basis, because Q1 for us is relatively subdued, there is a margin expansion, both in lighting as well as consumer electronics in our television business. On quarter, there has been a bit of compression, primarily because the demand in Q1 is normally subdued and the fixed costs remain the same. And we feel going forward, when you compare year on year in the following quarters, the margins would be in a similar range of what they were earlier.
Okay, so got that. So you're saying, so on a steady state, what margin should we look at in these two businesses, sir? Going ahead.
So we feel that in the case of lighting, the margins would be in the range of around 9%. And in televisions, it will be around 3.5 to 3.7.
Mr. Lal, let's talk about the mobile segment, mobile and EMS, because that's, whether I look at it year on year or quarter on quarter, I mean, that's one part of the business that's really firing away, and it's a large part of the business. Do you expect the next 3 quarters to also exhibit the same kind of growth? And what's the scope over there, given that, we have the Jio Bharat phone and quite a lot seems to be going on?
So undoubtedly, in our product portfolio, mobile and EMS is going to be the largest trigger of growth. It's the largest opportunity, and that's what we are capitalizing on. In mobile, we've had significant new customer acquisitions, which will get into the execution mode sometime in September on Q3 of this fiscal. So undoubtedly, that will be the largest trigger of our growth. And also in the EMS side, our business on accessories, that is hearables and wearables, is doing exceedingly well. That particular segment is on a big high and the order book is very healthy. So this will be the largest contributors to our growth plans in this fiscal and also the following years.
Okay, all right. Hi, good morning, Mr. Lal. What about for the year itself? What is the revenue number we should be targeting? You've had a good start to the year. Quarter 1 has shown good growth. Last year, you did roughly around 12,200 crores of revenues. So what is the number likely to be this year? And mobile and EMS, since that's the largest contributor, you're doing a run rate of close to 1,800 crores per quarter. How much is that likely to scale up to by the end of this year? Let's get those numbers out of the way first.
So we're not giving any guidance this year. But we would like to assure all the stakeholders that the growth is going to be much ahead of the industry growth, in line with the expectations and the expectations that we have built earlier. It's going to be much ahead.
So what is the industry growth you're factoring in there?
Look very good. And the largest contributor of this growth is going to be a mobile business and also the EMS business.
You want to give us what is the industry growth you're factoring in?
So industry growth is normally 12 to 15%. We're going to be ahead of
that. Okay, all right. Just a quick question on the TV business. Will you be able to cross the FY23 volumes? In quarter 1, it's down by close to around 5%. Also, for this business itself, where does your ODM share settle at? It's gone up from mid-single digits to around 29%.
So last year, we had done a volume of almost 3.4 million. In the first quarter, there has been a degrowth of 5%. We feel we're targeting in our internal budget, we're targeting a growth of around 8 to 10%. But let's see that how the festive period performs. I feel there's going to be in the range of 3.4 to 3.7 billion in the current fiscal as far as television volume is concerned.
Okay, Mr. Lal, just a word on margins. If I go back to the mobile segment, when volumes are growing there tremendously, you've outlined that. On a quarter-on-quarter basis, margins again came back to the 3% mark. They were above 4% in Q4. As we go forward, and then, on the con call, you also indicated that overall there is a thrust to push up the design side of the business, which obviously is margin accretive. So how will margins play out for the year in mobile specifically and overall blended EBITDA margins for the company? What is the expectation that we can work with?
So please appreciate that our design initiatives are largely confined to televisions, to lighting, to washing machines, and our new category of refrigerators. In that, please be rest assured the margins profile is going to be significantly higher. In the EMS side, the margins are in the range of around 2.7 to 3.5%. So they're going to operate in this particular range in mobile business and also our other EMS businesses.
Design significantly higher. Can you just tell us significantly higher in design would mean how much? And then where does it take the blended margin to?
So we target that in the ODM business, that's our own design product portfolio, the margins are almost close to double digits. And on a blended basis, the margins would be somewhere in the range of 4 to 4.5%. We try to push it towards 5%, but it's going to be somewhere in the immediate case because the larger trigger is on the EMS business is somewhere between 4 to 4.5%.
Okay, all right, we'll leave it there, Mr. Lal. We have more questions, but out of time, unfortunately, so we'll love to have you back for more details. Thank you indeed for joining us with that. Well, the market, every time we look at it, at least it's up another 20, 30 points. We're up 120 points, 19,800. So, well, at least that thesis for now is holding, is working. We perhaps completed something with yesterday's touch of that important retracement. We're above 19,800. Mitesh is with us. Mitesh, would you agree that sideways action perhaps got completed yesterday and another leg higher?
I'm not sure of that, Prashant. This could still be a situation wherein the market kind of, heads towards 19,900, 950 zones. Remember, we had a gap down on Friday last week, and we might be heading towards testing that gap. So as of now, I think it still looks like that the market, instead of correcting, will go into consolidation and therefore will not have much declines. But rallies will face a lot of pressure around this 19,950, 20,000 level. And therefore, it could be a 300, 340 point kind of a range. So as of now, I don't have clear signals to say that, we'll break into a new high. So we'll just hold our horses. And on the stock side, I have a buy on Apollo Tires. That's been a stock which has been making fresh highs regularly. So buy here with a stop at 421 for targets of 440. And Tata Consumer, something I would want to start with a disclaimer that we have recommended this. We also have positions over here. So vested interest is there. Tata Consumer is a buy with a stop at 868 for targets of 910.
Okay, Mitesh, thanks a lot for that. Made note of your picks as well. And by the way, we're holding at the high point of the day, 19,800. The call writers could be in trouble, and this could be the benefit of having some shorts in the position. Call writing and fresh short positions coming in from the FIs could actually be a good thing because they could be forced to cover up. For the time being, let's shift focus to the commodities market. Manisha Gupta is standing by to tell us what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'm looking at metals as a sector where we have seen some strength come back, and this is because of the softness in US dollar index. Even with some profit taking in some pockets there, we are still trading on the higher side of the range as it is. Take a look at the China markets where we did see the Politburo meeting pledging yet again on further stimulus and targeted stimulus measures coming in for various sectors there. There also are shortages in production as we have seen for the month of June and for the first half of 2023. There also is a report from S&P which says that the global car manufacturing is expected to continue to surge between 2023 to 2025, and that would mean a strong demand for metals continuing into the global markets. I want to talk specifically about the steel prices, which are trading at a one-month highs right now. There also was a report from the world steel production numbers that came in yesterday. for India, it really has been positive as far as the steel production goes. So for the month of June, it has been nearly 13% of a jump year-on-year basis on the steel production. And the first four months, or the first half of 2023, we have seen the steel production jump up by nearly 7.4%. I was also talking to BHP yesterday on Commodity Champions, and this is what they had to say in sense of steel production in India. In 2020, India was producing 100 million tons. Until last year was nearly 125 million tons. This year, the expectation is that India would be producing 134 million tons of steel. And by 2050, the expectation is that we could be hitting as high as 450 to 500 million tons as well. Another important data that came into light was that it is India especially which actually is looking at high margin steel production in the world itself. So when it comes to the Indian markets, and this is about better efficient and higher steel companies really, where you are looking at steel margins as high as $80 to $100 a ton. China continues to trade anywhere between $0 to $20 a ton in sense of steel production. So the Indian markets in sense of margins and profits also stands quite tall there. Finally, to the steel prices then, and this week has been quite positive, nearly 2% of gains, and that adds up to the July gains as well, 1.5% in the positive for the month as well.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. We are back. We'll have the management of CEAT joining us on the other side. Mr. Aruna Banerjee, the CEO at CEAT, to discuss their first quarter numbers. Stocks doing well. Stay tuned.
Look at that Nifty go, almost 19,800 on the screen. So the move is finally happening after a couple of very sort of lackluster days on the index. But we're sticking to stocks, and CEAT is the next company on the radar. The performance has been actually quite smart. It's the fourth consecutive quarter of margin expansion for the company. The margin is up a whopping 700 basis points year on year. Let's straight away take it to Arnab Banerjee, MD and CEO of the company. Mr. Banerjee, absolutely, hands down, fantastic performance on the margins. But allow me to just understand what's happening with the top line, because there one can argue that the growth has been a little sluggish at around 4%. What's the visibility that you have on volumes and top line growth for the next 1 or 2 quarters?
Yeah, the top line growth has been sluggish primarily because of flat growth in OEM sales. About 27% of our turnover comes from the OEMs. And there we are seeing a portfolio makeover as far as we are concerned. For example, we have exited from a lot of low rim sizes tires in OEM. And we are entering higher rim sizes tire in OEM. And the timing is a bit lagged. So over quarter 2, quarter 3, and quarter 4, we'll regain the market share in OEM. And it's a deliberate move. And it was known that it's going to happen this way, and it's good for the organization. Otherwise, exports have been growing very handsomely in double digits. The replacement market has been growing in single digit. So this overall growth is going to come back for CEAT.
All right. Good morning, Mr. Banerjee, and congratulations. What a solid showing. I wanted 2 numbers from you. One is on the margins, which have been steadily improving. Now it's at around 13%. So is there scope for it to improve from year on? If you could give us a band out there. And the second part is on the debt number. That's down by around 7% on a sequential basis. What's the trajectory out here? More debt reduction in store?
Yeah, I'll answer the second question first. If the profitability remains stable and steady across the quarters, we will see an impact on debt in the positive direction gradually as we go along. Our margin is expected to be stable over the next few quarters because raw material situation is pretty much benign. It's going to move in a very narrow band. We are holding on to a realization. Our gross margins, which is at about 41% this quarter, has reached the pre-COVID levels. So it had contracted by as much as 8-10% during the last 2-3 years because of hyperinflation. So we would like to hold our margin in that, the gross margin. And if we continue to grow, then our operating margin will also be steady in a narrow band.
Sorry, so margins should be around this, Mr. Banerjee, good morning, around the 13% level?
We would like to keep the margin stable around quarter 4, quarter 1 levels, yes.
Okay, got that. And you said that revenue also, I mean, OEM segment will also pick up in terms of, and you'll gain share there in the subsequent quarters of this financial year. So what does this mean for overall revenue growth for the full year, FY24?
Overall revenue growth, the growth will come primarily from international business, replacement business, and OEM business in that order. So we expect to grow single digit to low double digit for the full year.
Okay, 9 to 11%, basically.
Could be anything in high single digit to low double digit, yeah.
Okay. Okay. All right. Got that. Sorry. And you said that this flux that you talked about, I mean, portfolio makeover, I think is what you called it in the OEM segment. That's basically a customer or two related issue in Q1?
In the OEM segment,
yes.
The sales of lower rim size, I mean, the smaller vehicles, as you know, as a percentage of overall vehicle sales is coming down. And the growth is in the top end in the SUV segment that we all know. So CEAT's portfolio makeover is also going on. And we have exited a lot of small rim size vehicles and entering into the larger rim size vehicles, so which will go in trend with the market and maybe ahead of the market as we enter quarter 2, quarter 3, and quarter 4. And overall volumes will also come back to where it was.
Okay, so as this happens, what is going to be the targeted market share? I think in FY23, in two-wheelers, you were at 28%. So, okay, I mean, since there is a portfolio overhaul that's in the making as well, how should we understand your market share targets going forward, later this year?
Yeah, in two-wheelers, we would like to hold on to a number one status in replacement market and expand the market share from 28% to 30% and beyond. In four-wheeler, we would like to inch towards market leadership by 2026, and we would like our market share to close in on 18 to 20% in replacement market. And this would be mirrored in the OEM sales also, where gradually our four-wheeler market share should move up to somewhere between 15 to 17%, and two-wheeler market shares should stay above 30%, which is the current situation in OEM.
In electric vehicles, your market share is about, I think, 40%, sir. What's the aim here?
In electric vehicle, that is two-wheelers, where we are 40%. Yeah, and we would like to be dominant players in two-wheelers. We have started off fast and early, and we would like to maintain our advantage there. In four-wheelers as well, we are working on a number of projects with all the OEMs. We have got RFQs and nominations, and our product readiness is absolutely on spot. So we expect to have a dominant play in four-wheeler electric vehicle market as well. In truck bus radial as well, we have got an entry into one of the largest OEMs with our electric vehicle tire. It is buses primarily, not trucks. So across categories, electric vehicle will be a very big focus area for us, an area of growth.
That's very good to hear, sir. Thank you very much, Mr. Banerjee, for joining us, and we'll probe more the next time you're on the program. Thanks very much. So that's a good set of numbers, great margin expansion in the first quarter. We'll take a break here. My colleague Latha will take over, and she'll have Mr. R. Shankar Raman, whole-time director and chief financial officer at Larsen & Toubro, to discuss their first quarter earnings. Stay tuned.
Welcome back. Undoubtedly, the stock of the morning has been Larsen & Toubro. While the index itself is up and away, L&T is doing a lot of the heavy lifting along with Reliance. And why not? The results announced yesterday were a handsome beat on almost every parameter. And it was the nature of the beat by such a distance, as Jeffries tells us in their report, that the way in which the order book has grown, even with a 2% growth in order book, they will get their full year guidance, and they have 9 months. But the company has refused to immediately give us a new set of guidance. The only crib is about the margins, which of course was explained in the conference call. But I'm going to hop a little more on that, since that's the only one to grumble about. Let me welcome Mr. R. Shankar Raman, the whole-time director, CFO at Larsen & Toubro. Good morning, Mr. Shankar Raman. First of all, hearty congratulations, although I will start with the crib. It has been a handsome beat on everything. Okay, margins. You did point out in the conference call that the kind of, it was the non-margin accretive projects that were being done, and they were also won when commodity prices were, or at least the commodities were procured at high prices. But, you said it'll be subdued for a couple of quarters. Can you tell us what you mean by subdued? Does it go below double digits? And when you say it'll improve in fourth quarter, how much can it?
See, Lata, the context of all the conversation around margin is infra segment, because I think the hydrocarbon segment and the manufacturing segments have actually reported improvement in margin. So let's possibly dive into the infra segment, which is where the margin pain is being experienced. When I mentioned about absorption of costs that were committed in the post-COVID, post-war period, what I meant was the mix of jobs that we are currently executing has jobs which have been won in the last, let's say, 12 months, and jobs which have been won in the 18 months prior. So typically, we take about 3 years on an average to complete a project. So the mix is generally behaving in this fashion. When we talk about non-margin accretive jobs, we are talking about the cost overrun we have had in the projects that we bagged in late part of FY21 and in FY22, where the cost commitments could not have been delayed beyond a point, because at the end of the day, the project has to be completed to the customer. So waiting endlessly for costs to improve or inflation to come down would have been disastrous as an outcome for the company. So we waited as long as we could and then went ahead and sort of bitten the bullet, committed the costs, and that has enabled us to actually report growth in sales volume now. The momentum of sales growth that you see in the last quarter of the last year and the first quarter of the current year is largely as a result of execution pace picking up so that we could complete projects on the time committed to our customers. So it became inevitable that the jobs that we were executing had inherently diluted margins than what we actually got into the contracts with. Now, this mix does not change overnight. Now, given the nature of the project business and having a 3.5 year life cycle for its completion, the change in the mix would be gradual. So when I say it will be subdued in the next couple of quarters, what I meant was it is not as though the last of the high cost have gone out of the financial statements on 30th June. There are still possibly 20% of our revenue coming from jobs which have been affected by these inflationary pressures. And this 20% will come down to 10%, to 5%, to 0% over subsequent quarters. So it's very important that the mix of jobs that we have acquired in the recent past starts contributing to revenue generation. And once that happens, the change in the margin profile will become an inevitable.
No, sir, I understood it perfectly even when you explained at the conference call. What I'm only asking is that this 20%, which you say are those, because of the chronology, non-accretive, will it take it below 10%, your margins?
See, currently, we are at margin construction infrastructure business. We reported a margin of 5.1%.
Okay.
6.5% was the margin last year. I'm just talking about the infra piece.
The construction business, yeah, got it.
The P. Okay, on a normalized basis, this segment has a potential to make about 8% margin. When you mix it up with the manufacturing activity that we have and the hydrocarbon business that we have, then the margin profile improves from the 8% for infra segment to a blended average of 9.25. That's where the margins will be.
Okay.
So our efforts would be through the subsequent quarters, discover our path back to those kinds of line. Our guidance for the year given out in May was 9%. So we've not yet
Yeah,
gone
you're referring to core margins. Okay, I get that. Okay, let me, get to the buyback, though I have a lot more execution and project questions. Why the buyback? Look at the share performance over the last 1 year. It's a 50% rise. Let's pull up the 1 year chart and you will get an idea. What were you all at 1,700, 1,800? Now, already at 2,500, 2,600. And, this buyback will give you another 17, 16%, taking it to 3,000. If you kept the money with you, it would anyway go to 3,000. Look at the Jeffries and all of them. They're anyway giving you a share price. Why are you giving money away to shareholders? You all are doing a better job. Why didn't you keep it?
Lata, fortunately for us, even though there's a lot of stress in executing projects, it's not a very capital intensive business. And if we are very discreet and thoughtful about capital allocation, the money would generate every year on year basis is available for servicing debt, which is very low in our books. The entire group debt is dominated by financial services debt. So if you exclude that, the debt levels are very low. So there is very little capital that is required to service the debt. Now, we are actually trustees of shareholders, and it is a company which is owned by everybody and anybody. Now, that being the case, I think our job is to make sure that we add value to shareholders. And one way to do that would be to have healthy profits, healthy dividend. And whenever the surpluses are far higher than what the company requires, looking at the next couple of years, its own investment program and its own working capital requirements, the money is best given back to the shareholders. The whole idea of our philosophy is that we work to shareholders' value creation. We do believe this is a good return that we would provide to the shareholders. They've waited for long, and as I told you, the first time ever in our history we've ever been able to do this. Our belief is that we want to get onto a model which will be cash generative, and hence we will have a program of dividend on a healthy continuous basis, as well as periodically we will have to see how buybacks can be done. The share price per se does not determine this philosophy. The idea is we need to make sure we are high on ROE and we are able to have the shareholders have money in their hands.
Okay, so you will soon be not just an EPS generating company, but also a yield generating company. I guess people will make those calculations. Since you're speaking about EPS and the Lakshya and the ROE, targets, let me come to some of the financial parts. MSCI has upgraded your ESG rating to BB from B. Now, how does that work into the finances? Does that make it easier? I believe that you all also have done a ESG audit of all your plants, and you're working towards near zero living off the environment. So should we expect a lot of financial gains from this? And by when?
As I see it now, what drives us toward ESG is our own sense of responsibility towards a better planet. I think we are not looking at it merely from the point of view of how it would benefit financially. The cost of transition is a major topic world over. People are yet to figure out as to how this cost of transition would be financed. Ultimately, whether it will be channelized through government to public pocket is something that needs to be worked out. Since we are in the business of construction and projects, etc., we inherently are carbon emitting operations. We cut trees, we do things, we actually destroy before we construct. So this process of deconstruction has to be compensated. So consequently, what we have got us working on is to see how to decrease the emissions. So we've set ourselves targets year on year as to how to reduce emissions progressively. For example, sourcing green power.
No, sir, I got that. Forgive me, I'm sorry I'm interrupting you, but it's just that I'm trying to pack in more questions. I just want to know whether at the moment it impacts your cost of capital. I mean, how quickly will you see it in terms of gains, lower cost of capital?
No, I don't think you will see it soon in terms of lower cost of capital, but it does a lot to our emotional capital.
Oh, okay. Got that. I'm sorry if I'm pushing you. It's just that you've won so many brilliant projects that I wanted to speak a little more about the NEOM green hydrogen project as well. That's a huge one, isn't it? Even in terms of the amount of money, over $2 billion. So do these projects from the Middle East come with higher margins?
Intrinsically, yes. It all depends on how smartly we execute the projects. Because I think the price points of markets outside India is definitely better. But the task of executing it in foreign land to comply with the foreign regulations, to make sure that you meet the localization requirements, etc., has its own cost impacts as well. But having said that, I think it is very important for us to get the kind of pre-qualifications we have got. As we speak, over $5 billion worth of solar green related projects we are executing in Middle East. And Saudi Arabia actually is one of the largest markets. So I think we do believe that we should be able to help the margin accretion overall by executing these projects well. It has gone off to a good start. I must say that we had a very rough start because as we got into these projects, the module prices, the polysilicon prices, etc., shot through the roof. But then, since it was such a global phenomena, the clients were understanding. So we were able to redraw the timeline, wait for things to cool, and then move forward. So to that extent, we've been able to de-risk. So there are risks, as is the case with any projects in solar green projects as well. But we hope that wiser by all our past experiences, we will do a better job.
Okay. Well, I know realty is a small piece for you, but it looks like you are coming with very ambitious and very intelligent financing, if you please. This Capital Land India Trust Management, it's almost like self-financing your realty. And it also means a lot of office space and then the residential space that you have tied up with HDFC Capital Advisors. Together, can this contribute to L&T's kitty? Can you give any numbers and timelines?
At the moment, let me mention that over 12 million square feet of residential area is under development and over 15 million square feet of commercial area is under development. Our plan was to see how we can do about 50 million square feet. Obviously, I think it is capital intensive business and you have to build, wait, and then sell and realize the cash. And that was going contra to our ROE plans. So we decided that we will actually use the best part of our skill sets, namely the design, engineering, construction, marketing, etc., and get somebody who can finance the acquisition of the land and development of projects. And that's where the platforms that you spoke about come into play. So we will use the third party's funds platform, bring in our real estate development skills, and possibly get a return which will be high on ROI because our investment will be low, but it is definitely in absolute terms lower than what we would do had we put that in our balance sheet directly and done start to finish.
Okay. Will you list it separately anytime soon?
No. I don't think there is plan to do that. Okay. I think first we want to make sure that these revised transformative models actually work, and we would possibly look at it in the next strategic plan perhaps.
Okay. All right. Mr. Shankaran, I'm not out of questions. I haven't even begun with Hyderabad and Nabha and the other projects, but we are in the thick of results season. So Chartbusters is knocking at my head to wind up. Thank you very much. Pleasure. I'll take a rain check from you for another interview soon. Well, we leave Bazaar with the markets absolutely flying high at the highest point of the day. Chartbusters takes the action.